Ladies and gentlemen, imagine waking up tomorrow morning and discovering that the people who spent years betting against an asset are suddenly doing everything they can to own it. Not quietly, not gradually, but with the kind of urgency that only appears when something important has changed beneath the surface. Now imagine that almost nobody on television is talking about it. Instead, the headlines remain focused on interest rates, inflation, politics, and the latest stock market swings, while one of the most fascinating shifts in the precious metals market unfolds almost unnoticed. Because every now and then, Wall Street sends a signal that is impossible to ignore, not through speeches or interviews, but through actions. And history has taught us one simple lesson. The smartest institutions rarely announce what they believe. They position themselves first. Only later does everyone else discover why. Today, I want to tell you the story of one of those moments. A story that begins with a name almost every investor recognizes. A name associated for years with enormous positions in the silver market. A name that many believed represented one side of one of the longest-running debates in modern finance. And then, something changed. Reports began circulating that this same financial giant was increasingly taking delivery of physical silver instead of simply participating in paper transactions. For years, conversations around silver often centered on who was selling. Now suddenly, attention shifted toward who was taking possession. That is not the kind of change professionals ignore. It is the kind they study very carefully. Because markets are built on one simple principle. People's opinions matter, but their actions matter far more. And when one of the largest financial institutions on earth appears to change how it approaches a market it has known better than almost anyone else, every serious investor should at least ask one question. Why? Not, will silver double tomorrow? Not, should everyone buy immediately? Those are emotional questions. The better question is much simpler. What changed? Because whenever experienced institutions begin acting differently, something underneath the surface is usually evolving long before the headlines catch up. And that brings us to the mystery we are going to solve together tonight. Did Wall Street suddenly discover something new about silver? Has the structure of the market quietly begun shifting? Or are millions of investors reading far too much into a move that has a perfectly ordinary explanation? By the end of this video, you will understand why this debate has become so important. You'll understand why experienced investors watch deliveries instead of headlines. And perhaps most importantly, you'll understand the enormous difference between believing you own silver and actually owning it. Because those two ideas sound identical, but in the world of finance, they are separated by an invisible line that most people never notice, until it suddenly matters. Before we go any further, let's clear away one misunderstanding. Every financial market develops stories. Some are true, some become exaggerated, others live somewhere in the gray area between fact and speculation. Silver has always attracted passionate opinions. Some investors see it as an industrial metal. Others see it as real money. Some believe it remains undervalued. Others argue it simply follows economic cycles like every other commodity. Reasonable people disagree. That is perfectly normal. But every so often, a market produces something more valuable than opinions. It produces behavior. Behavior leaves footprints. And footprints are much harder to ignore. Think about a neighborhood where every house looks perfectly calm. No smoke, no alarms, no obvious danger. Yet suddenly, several experienced firefighters quietly arrive. They don't make speeches. They don't hold press conferences. They simply begin preparing their equipment. Even before you understand what they know, you instinctively realize something has captured their attention. Markets work the same way. Large institutions rarely move billions of dollars because of emotions. They respond to incentives, risk, opportunity, supply, demand, or changes most people cannot yet see. That is why this story has captured the attention of professional investors around the world. Not because anyone believes one institution controls the future, but because unusual behavior often deserves careful observation, especially when it comes from participants who understand the market better than almost anyone else. Now, to appreciate why this reversal has generated so much discussion, we need to understand something surprisingly simple. For years, many people thought about silver in only one way. Price. Is it rising? Is it falling? Should I buy? Should I sell? But professionals often spend surprisingly little time staring at today's price. Instead, they ask a different question. What is actually happening beneath the price? Because prices tell you what happened, market structure often tells you what may happen next. Imagine walking past a lake. The surface appears perfectly calm. No waves. No movement. To most people, nothing seems unusual. But underneath, powerful currents are quietly changing direction. The calm surface tells only part of the story. Financial markets are remarkably similar. Sometimes the biggest developments occur where very few people are looking. Behind delivery reports, inventory movements, industrial purchasing, storage trends, and the quiet decisions of institutions that rarely explain themselves publicly. Those are the currents beneath the surface. And lately, many of those currents have started flowing in unexpected directions. Which brings us back to silver. For decades, most investors interacted with silver through financial products, brokerage accounts, exchange-traded funds, futures contracts, mining shares, digital positions. Convenient, efficient, easy, yet very few people ever stop to ask an obvious question. Where is the actual metal? Because there is a remarkable difference between participating in the silver market and physically possessing silver itself. At first glance, they appear identical. Both rise when prices rise. Both fall when prices fall. Both give exposure to the same commodity. Or so it seems. But imagine something completely different. Suppose 100 people purchase tickets for a concert. Owning the ticket gives them a claim. The concert hall represents the real event. As long as everything functions normally, nobody notices the distinction. The ticket works perfectly. Now imagine something unexpected happens. Suddenly, everyone decides to attend. Every single ticket holder arrives at the entrance at exactly the same time. That is the moment the system discovers whether every claim can actually be honored. Financial markets contain similar ideas. Many participants are perfectly satisfied holding financial exposure rather than physical possession. Most of the time, that system works efficiently. Trading remains smooth. Liquidity stays abundant. Confidence remains high. But every now and then, large institutions begin showing greater interest in obtaining the underlying asset itself. Not because paper exposure suddenly becomes worthless, but because physical ownership can offer different advantages depending on market conditions. That distinction, paper exposure versus physical possession, has quietly become one of the most discussed topics in today's silver market. And understanding that difference may explain why experienced investors have become increasingly interested in delivery data instead of simply watching the daily price. Because once institutions begin asking for the asset itself, people naturally begin asking another question. How much immediately available silver actually exists? That question sounds simple. Its answer is anything but simple. And what happened next surprised even seasoned market observers. Because the deeper analysts looked into inventories, industrial demand, and physical availability, the more unusual the picture became. The story was no longer just about silver's price. It had become a story about access, availability, and who wanted to secure real metal before everyone else noticed the shift. In the next chapter, we're going beneath the surface of the silver market itself. We'll uncover why professional investors often say there are two different silver markets operating at the same time, why those markets don't always move together, and why that distinction may be far more important than tomorrow morning's silver price. Because once you understand that hidden system, you'll never look at a silver headline the same way again. Before we reach the end of this story, I want to do something that many financial videos never do. I want to show you the other side. Because whenever a market begins attracting extraordinary attention, certainty becomes dangerous. And if someone tells you there is only one possible outcome, they are asking you to stop thinking. The truth is that intelligent people can examine the exact same information and arrive at very different conclusions. That is not weakness. That is how markets have always worked. Some analysts look at the recent increase in physical silver deliveries and believe it marks the beginning of a structural change. Others argue it is simply part of normal inventory management. Some see tightening supply. Others see temporary logistical adjustments. Some believe industrial demand is entering a new era. Others point to slower global growth and argue that demand could soften before supply becomes a serious issue. Who is right? The honest answer is, no one knows with certainty. Markets are living systems. Every day, millions of decisions interact with one another. Interest rates change. Governments introduce new policies. Factories expand. Consumers slow spending. New mines begin production. Existing mines experience disruptions. Every one of those events alters the equation. That is why experienced investors spend less time predicting tomorrow, and far more time preparing for multiple possibilities. Because preparation survives uncertainty. Prediction often does not. Imagine standing at the edge of a river. You cannot control where the current goes, but you can choose the strength of the boat you build. That is the difference between speculation and preparation. One depends on being exactly right. The other depends on remaining resilient even when the future surprises everyone. So instead of promising you a single outcome, let's explore 3 realistic paths the silver market could follow from here. Not fantasies, not guarantees, simply possibilities. The first scenario is the quiet continuation. In this version of the future, industrial demand continues growing steadily while mining production slowly adapts. Physical inventories remain relatively tight, but markets continue functioning without major disruptions. Silver prices may rise over time, but gradually. There are no dramatic headlines, no overnight explosions, just years of slow appreciation driven by steady demand from technology, renewable energy, medical equipment, artificial intelligence infrastructure, and advanced manufacturing. History reminds us that many important investments created wealth this way, patiently, almost unnoticed, until people looked back years later and realized how much had changed. The second scenario is more volatile. Imagine confidence beginning to shift. More institutional investors decide they want direct exposure to physical metal rather than purely financial instruments. Industrial buyers become increasingly focused on securing future supply. Inventory levels tighten further. The difference between immediate availability and future promises becomes more noticeable. In markets, perception often changes faster than production. A mine cannot simply double output because prices increase. Developing new supply takes years. If demand accelerates while supply responds slowly, prices can move much faster than most people expect, not because silver suddenly becomes magical, but because economics begins doing what economics has always done. Scarcity forces prices higher until balance returns. History contains many examples where markets remained quiet for years, only to reprice much faster than anyone imagined once expectations changed. Whether silver experiences such a move remains uncertain. But history tells us it should never be dismissed simply because today's conditions appear calm. Then there is the third scenario, perhaps the most overlooked of all. Imagine the physical market remains relatively tight, yet financial markets continue operating smoothly. Paper trading remains active. Industrial demand grows at a manageable pace. Global economic growth slows enough to reduce immediate pressure. Silver neither collapses nor explodes. Instead, it spends years moving through periods of optimism and disappointment, enough volatility to frustrate traders, enough long-term demand to keep attracting investors. This outcome may sound less exciting, but markets often spend far more time consolidating than they do making dramatic moves. That possibility deserves just as much respect as any bullish prediction. The important lesson is not deciding which scenario must happen. The important lesson is understanding why each one remains possible. Because the future is rarely written by certainty. It is written by probabilities. And probabilities constantly evolve. That brings us to something far larger than silver itself. Financial history. If you study enough market cycles, you begin noticing the same pattern repeating across generations. Different assets, different countries, different decades, yet remarkably similar human behavior. When an asset becomes unpopular, people assume it will remain unpopular forever. When optimism reaches its peak, many assume good times will never end. History has humbled both groups countless times. During every major financial cycle, the crowd eventually becomes convinced that today's conditions are permanent. But permanence is perhaps the greatest illusion markets ever create. Interest rates change. Currencies evolve. Technologies reshape demand. Governments introduce new policies. Global trade reorganizes itself. Entire industries appear almost overnight. Markets adapt. Always. Sometimes slowly. Sometimes with astonishing speed. That is why experienced investors spend less time asking, "What happened today?" and more time asking, "What direction is the world quietly moving?" Because long before prices reveal the answer, behavior often does. Factories order equipment. Governments secure strategic materials. Institutions rebalance portfolios. Manufacturers sign long-term supply agreements. Small decisions accumulate, until suddenly everyone notices the trend that had been forming for years. By then, the headlines describe what already happened, not what is beginning. There is another lesson financial history teaches again and again, perhaps the most important of all. Every generation experiences moments when confidence is tested. Confidence in currencies. Confidence in banks. Confidence in governments. Confidence in markets themselves. Most of the time, that confidence deserves to exist. Modern financial systems perform extraordinary work every single day. But history reminds us that confidence should never replace understanding. Because confidence is emotional, understanding is durable. That is why wealth preservation has never been about predicting every crisis. It has always been about building resilience before uncertainty arrives. Think of it like owning a home. You buy insurance hoping you never need it. You maintain the roof before it leaks. You prepare for storms while the sky remains blue. Preparation rarely feels exciting, until the day it becomes invaluable. The same principle applies to investing. The strongest portfolios are rarely built around excitement. They are built around balance, diversification, patience, discipline, and understanding that no one can consistently predict every market move. And perhaps that is the greatest misunderstanding surrounding precious metals. Some people view them as lottery tickets. Others dismiss them entirely. History suggests the truth often lies somewhere between those extremes. For centuries, gold and silver have played different roles during different economic environments. Sometimes they outperform, sometimes they lag, sometimes they spend years doing very little. Their importance has never come from guaranteeing wealth. It has come from offering diversification during periods when certainty becomes difficult to find. Whether today's market eventually proves significant, only time will answer. But asking thoughtful questions today costs nothing. Ignoring important questions simply because today's headlines appear calm has often been far more expensive. And now, we return to where our story began. One of the largest financial institutions in the world appears to have approached the silver market differently than many expected. Analysts continue debating what that means. Some believe it represents a profound signal. Others remain skeptical. Reasonable arguments exist on both sides. But one fact remains unchanged. Actions often deserve more attention than headlines. Because institutions reveal their priorities with capital, not conversation. The market will eventually decide which interpretation proves closest to reality. It always does. Until then, curiosity may be one of the most valuable assets any investor can own. Keep asking questions. Keep studying incentives. Keep watching the trends beneath the surface rather than simply reacting to today's price. That habit alone separates observers from students of history. And history has a remarkable way of rewarding those willing to learn before everyone else becomes interested. So before we finish, I'd genuinely like to hear your perspective. Do you believe the growing attention on physical silver reflects a long-term structural shift? Or do you think the market is simply experiencing another temporary cycle that investors are overanalyzing? More importantly, if you had to choose only one, would you rather own physical silver or financial exposure through paper instruments? There is no perfect answer, but your reasoning may help someone else see the market from an entirely different angle. Share your thoughts in the comments below. I read them because some of the best insights come not from headlines, but from thoughtful conversations between people who have spent years watching these markets evolve. And if today's documentary helped you see silver through a different lens, if it replaced noise with understanding, then consider subscribing. Because every week we look beyond the headlines, beyond the daily price swings, and into the deeper forces quietly reshaping money, commodities, and the global economy. The biggest moves in history rarely begin with celebration. They begin in silence, while most people are looking somewhere else. Thank you for watching, and until next time, keep watching what the crowd ignores, because that is often where tomorrow's story begins.